It's Friday. I'm here with two of my favorite partners, Robert Marson, who's hanging out in sunny southern Florida, and Charlie the Gypsy Peabody, where we don't really know where he is on a daily basis,
One
but
step
he
ahead of
is
the government.
definitely in tune with the market, and it's been quite a week. So let's start with Robert and lead us off, buddy.
So when the market goes down and they arrest all the girls, if you know the beginning half of that statement, um, you tend to want to upgrade the quality of your portfolio if you can. So I have a change in a portfolio. I have an earnings report and a new buy that was an old buy and sell. I have three ideas to talk about. So we'll start with the swap first. Everybody knows I had bought some American Eagle down from 26 to 16 to 17, and it was a starter position. Never got there. The stock was 10 times or 8 times earnings and cheap and half a sales with a good balance sheet. And that's a deep value company with mediocre fundamentals because they had guided down a couple times and that got the stock down. And it's dubious quality management, even though on their slide deck and on their website they say world class management. I would remove the CL and call it world ass management, because when you have a stock that's missed the greatest bull market in the history of freaking mankind for 20 years, you don't say world class anything. Okay? Period. All right? So I'd call it world ass management.
That's pretty good.
That's
I
what,
agree. I
that's
agree.
what shareholders have gotten for 20 years, a heaping pile of ass. So I bought it despite that. But when Abercrombie and Fitch, which we've talked about, hit 200 or 180, I said that's a profit-taking panic candidate, because it went from 25 to 100, 198, I think. And I said, when that sucker hits 100, I'm going to buy it. Well, it hit 100 2 days ago. And when I put my order in, it had opened up $4. So I paid about 104, which is $2 higher than it is now. But Abercrombie is doing much better, has much better management, has sort of found a way to get 15% operating margins when not too long ago they aspired to 10 while they did 5. Now here's the trick with it. They're both single digit P's. One is under earning and has sort of questionably competent management. The other one is doing so well, one could say in Abercrombie that they're sort of experience a peak level of profitability. So we don't know if the 15% at the beginning of 2 years ago, 2024, 2023, they were doing 5 to 6% operating margin, and they aspired to 10 in a few years, and then they got to 15. So even though they're making $11 and it's a $100 stock, normalized earnings might be 8, 9. If they grow 5 to 10%, they could take 5 to 10%, hit the margin, and keep earnings flat. Flat earnings are not sexy stories. People don't like that. So I'm going to still be facing a bad chart and a market that's uncertain of normalized earnings. But again, I just swapped the world ass management for maybe world class management. At least is how they're they're executing today. So I took my starter position. I took a 20% hit to my position in American Eagle. I have a lot of short-term gains I booked in January on my 100% by 25% thing, where you sell after 100% trade, you sell 25% to de-risk the trade. So I have a lot of short-term gains that were booked in January that I didn't want to take in December. So I don't mind taking a small loss in the stock to upgrade the quality. So that was one of my. So now I'm long a starter position in ANF with about $104 cost basis. The second one is Chart
I like that.
Industries.
I like that. By the way, and just stop you for a second. Like, that is, first of all, Robert is a very disciplined man in how he runs his book. Like, and you have to respect him. Like, he has rules and he does things a certain way, and that's why he's been successful over time. But I think that that's right. Like, there's stocks that you want to buy them when they're out of favor in the short term, but the long term trend has been positive. I mean, that is we talked about Powell Industries and Vertiv and some of these, AI derivative plays. Now that AI is getting thrown out with the bathwater, baby, the bathwater, and so like I give you a little golf clap for that buy.
We'll see. We're going to declare victory or defeat in 6 months, so we'll see what happens, Ben.
Yeah, whatever. I just like the strategy is all I guess I'm
Yes,
saying.
the strategy makes sense, and you can only do it when everything that you're looking at, including owning, is in a free fall. But you do want to try to upgrade your portfolio when the good, the bad, and the ugly are down. And so far, this is still good. The one I sold is ugly, right? So I swapped ugly for good. So the second one is Chart Industries, and GTLS is the ticker. That was a famous idea on the show because I said, I'm buying, bad chart makes chart good buy, and the stock had gone from 175 or 180 to 110 on an earnings miss in the summer, and it's hopefully it's the next ANF is the next chart. We'll see, but they had solid growth. It was disappointing. They had solid sales or earnings growth, and the street just it has a very high beta, so people got bent out of shape, puked the stock down to 110, where I did a buy on it on the show, and then I filled it in at about 115, so I'm in that range. But when it got to 200, I took a 20% profit in the share count, and they reported today the numbers. They missed a little the fourth quarter. They reiterate their guidance. It's a leading company for cryogenics and power equipment, pumps and fans, and all the kind of things that move natural gas and process oil and gas and other kinds of industrial gases. So they're a leading company, compressors in the industrial gas business. Right now, LNG is getting a big play from the U.S. to the rest of the world because the rest of the world needs AI electrons too. And as far as I know, the rest of the world hasn't been investing in carbon for a while, carbon-based electricity. And they need, they're shutting down their coal, they're shutting down their nukes, and they're trying to go to, wind and sun, and that's just stupid. So these AI data centers, they need a lot more than a couple of wind farms to run them. So I believe there's going to be a boom in LNG gasification and regasification liquefaction and regasification, around the world. So this company is, in my opinion, better than an independent power producer here because it's going to experience an LNG led boom around the world as Africa and Europe and Southeast Asia, they all go to try to add electricity to their AI-driven data center build-out. So it's stock is about 175, 180. It's in no man land today. It's kind of too cheap to sell and too expensive to buy it back. So I'm just holding it. But the numbers were good. The outlook was good. The company delevered the way they said. They reiterated their outlook for 2025. Back end loaded. A lot of companies in the industrial world, Ben, are back end loading the year. So, I really
Hockey
hope
stick, the proverbial Wall Street hockey stick.
Yeah.
Where
Yeah, not as bad as a hockey stick, but something, a broken hockey stick maybe, right? Where it's a little more linear, So that's good. And then the final thing, when I went into crowdsourcing defense ideas, I bought TAT, which and that's an aerospace company, and I also bought Mtron, which is MPTI. I didn't get a more than a starter position. I bought that in the 36 range, and it paid me what I expected to get paid in over a year in 3 months. So I ended up selling it at 63 fully, and it was a grudge sale because I only had a starter position. When you double your money in a 1 or 2% position, you feel more stupid than happy because you should have had them. I mean, my average position is 5 to 6%, right? So if I'm doing a 1 to 2% position, it doubles in 3 months. I'm more pissed at myself than I am happy for doubling my 1% money, right? My 1% position money. So I grudge sold it. It went to 70 in about 3 days, and they've had good quarters since, but they made a very funky announcement that the CEO was going to go leave the company to go to a PE startup firm. The company was going to raise money and invest with the CEO in this PE firm, and they were going to sell $25 million worth of stock and rights in order to pay for it. Well, the stock went down 25% on that, and now they're not going to sell stock. So that's good. The market gave them a raspberry.
Remind the viewers what the ticker is again, because I'm going to pull it on my chart right now.
MPTI.
MPTI. Okay.
Yep. So I got Mtron. I got out in it's a defense electronics company. It's a very niche business. It's tiny. It's 50 million in sales and 100 million plus in market cap. And it trades by appointment only with a wide spread. But I like having fun with these ideas. And when you double your money, it's still fun.
It's on sale. It's on sale. That's for sure. Sale. Relative to Christmas, right? So it's 50% off sale.
50% off sale, right? And it's a defense stock, and not many defense stocks are 50% off. And I think it's 50% off, not because the numbers were bad, but because the CEO left, and they announced a $25 million equity and rights offering. So they canceled that because of the stock price performance. I talked with the CEO, and they think they're going to grow sales more than 10% this year organically, and they think they're going to grow earnings faster than sales. So I have them making about $3 in earnings in 2025, up from $2.30, $2.40 for last year. And at $3, a high quality defense electronics firm today trade at least 20, because there's serious IP these guys have. So I'm thinking the stock, I'm hoping to sell the stock in a year at the same price I sold it last year at, $60. So I got back in at 38 and about $38. Started buying at 36 and change, 37, paid up to $40 for it. So that's where I stand. MPTI is a ticker. It's thin, but it should be a double in a year if they hit my earnings target. So that's the three.
I mean, look,
that's the set of trades and reports I have for today.
And I look at that chart, and it's a good reminder that when you deal with small cap stocks, these are not stocks that are real securities. I mean, there are obviously real securities, but the way they trade is, hey, if someone wants in or out, they're going to push the stock around, right?
Yes.
And so you have that vol component of it. When I look at this, it's like somebody wanted in, and then somebody wanted out, and then you're like, all right, well, It's actually great because it's like old school of like, hey, I need to know the levels where I want to buy this at, know what I'm buying. Because again, you're not dealing with all the stuff that we deal with in the larger mega cap world. Like no one's there to save you in MPTI. You better know what you're buying.
No one's there to say, God, MPTI is dirt cheap. I got to buy it down 20%.
Yeah, exactly.
These things go down, and you're seeing that in Ceragon, which doubled for us and is essentially round trip because they had a shitty call where the CEOs, they had a 3% miss on revenues for this estimate year and maybe a 15% estimate reduction. And the stock goes down 50% because the knucklehead CEO says low visibility 5 times in a conference call. There's literally no bottom in the stock. I might go back to 230, 250. I haven't even tried to buy stock because I just want to wait and see how low the dumbest guy is that sells it at the lowest price. And then when it stabilizes, I'll try buying some. But there's no universal knowledge in this when people say it's cheap. That's what when you have small stocks, you have to expect outlier moves up and down.
Yeah, for sure. And that was kind of my point of making that comment.
Yes.
is that small cap stuff, you gotta think about the price chart differently than when you look at Home Depot or something like that. Although I will say the action we've had in this market where Costco and Walmart are trading like Palantir, it's not a normal situation for those either.
They are. Ben and Charlie, they do represent businesses, not just commodities, supply and demand for the stock. And when a business gets too cheap, something could happen. These guys have said they're for sale on the conference call yesterday. Okay.
Wow.
They're trying to buy, but they're also available for sale. So, at one time, at 2 times sales with 48% gross margins and 15% net margins, that's a business that would, get bought out at twice the price from another
You know,
defense electronics
by
company.
by by saying you're for sale, you can jack up your stock price and then use that currency to buy somebody else. I mean,
Yes, they're trying. Trying to do both. They need to either get bigger, but they're willing to become
yeah,
a part of a bigger organization.
there
You can get
there's a
that
bank.
reflexive wheel going, the Elon Musk wheel.
And
Yeah, and by the way, Robert, you know that I'm a value oriented long guy, so
Yeah.
I appreciate things that are out of favor, like my Budweiser, which is now at $60.
well done, Ben.
Yeah,
Well
King of
done.
Beers,
Well,
baby.
this
And to
Bud's
be
for you,
fair,
buddy. You should
to
have
be
titled it
fair,
this. You should have titled your notes. This
Robert
Bud's
was
for
one of my
you.
first calls. Robert was one of my first calls when I was telling him, I was like, I think I got a stock. I gave Robert the call, and he was like, too much leverage for me, because he's a disciplined investor. But
No,
And,
yeah,
well, Ben,
Robert's a
I have
Pabst
two
Blue Ribbon
portfolios.
guy.
I have two portfolios, and I need to see 100 to 200% in 3 years in a stock. So it was
yeah,
it was
yeah,
a,
yeah,
it was
That-
a nice
that-
stock for 30. Oh, it's a nice stock for 20 or 30% trade. I get it, but that's
yeah,
not what I-
exactly. All right, let's move to my man Charlie Peabody. What's happening,
Yeah.
Charlie?
Well, I got a potpourri of things this morning.
All right.
Just want to quickly review the pending home sales data that came out yesterday. So pending home sales were down 4.6% in January to the lowest level in history. Now, so that's the chart showing pending home sales going back to 2000. So, keep in mind that this pending home sales is contracts that have been signed but not yet closed. So they will close in about 2 months. That's when you'll get the existing home sales data, what this sort of forecasts. So it foreshadows a weak start to the spring selling season. Jen, I don't know if you want to go to the bullet points around this, but so this is what I just said, that they had plunged in January, lowest level in history. So it's adding to the widening cracks that I've been highlighting in the foundation of this housing market. On the next bullet point, basically what I'm saying is obviously this is not a good sign because it's a leading indicator for existing home sales, which says that the spring selling season has started off weak. Now, I want to be careful. January was when mortgage rates were still around 7%. And we're seeing a fairly significant drop in mortgage rates since January, and probably are going lower if Ben is right. And usually Ben is right. So, the selling season, could have a pickup if mortgage rates come down. And that's something that, I've talked about. Many of these home builders are off 30, 40%. If rates come down and we have a stronger spring selling season, we're going to get some kind of dead cat bounce. But I really do believe that dead cat bounce is to be sold, and we'll cross that bridge when it happens. The other and the reason I want to continue to sell the home builders is in the next chart for completed new home sales. I don't know if you can put that up. So this is completed new home sales, and you can see since basically since 2020, the number of new homes for sale has increased dramatically. And so the big risk for housing is if inventory continues to accelerate from here, which is what happened in 06, 07. If you go back to 06, 07, we are at the level where things just accelerated because there was a complete collapse in demand, and there was still overbuilding. So the new construction needs to slow in order to avoid a glut. And that right now is being reflected in weaker, housing starts and permits. So that leads me to my next chart. Sorry, Jen, I apologize. If you can go to the next chart, and as sales slow and inventory grows, there's less need for construction jobs. And that's important because housing has a big multiplier effect on GDP. So, and construction jobs are one of the more leading employment indicators. And I've, cautioned that, while we may get a dead cat bounce here, there's still another leg down in these home builders. And I think that one is going to be more characterized by higher unemployment rates. So the first leg down that we've had since September, October has been really a function of lack of affordability. The next leg down is going to be a function of higher unemployment. So the problems plaguing home builders is already bleeding over into the labor market, as we've seen in housing related employment. So Jen, actually, if you can go back to the chart so people can see what's going on here. The construction job openings from the JOLTS survey have dropped by over 50% since their peak early last year. And it's and that job creation in the construction industry is not likely to pick up anytime soon, given the recent poor NAHB sentiment readings, where home builders were expressing concern about future sales. So the recent reduction in job openings for construction workers signals more trouble ahead, not just for housing, but I think also for the economy. So I just wanted to go through those three charts. We've had a lot of housing data in the last week and a half. This is the sort of the tail end of it, and we go into a lull. But the general picture that all of these housing data releases draw is indication that things are slowing, and I think the markets obviously are already reacting to that. We have developed in the markets some kind of growth scare already. So, any questions on that, Ben? Before I go to the next thing I want to talk about.
I think look, you've been very right on this call. The home builders have been a nice sell. I think that it's very clear that this administration wants to get rates down. I think the market's finally appreciating that, and I've been a pretty adamant bond bull, which I changed my tune on that at some point last year. When did we say short bonds? Was that like mid-September when they did the cut?
Yeah, it was because
yeah, it was like okay, that's what it was. All right, they did the cut, and we were both like, "Hey, it's time to short bonds," and it was a really good short actually. And then I don't know exactly when it was. Was it mid-December or sometime? No, maybe it was mid-January. That like 470 long end, and I thought that maybe we'd get a flattener, and we flattened pretty good.
We definitely got a flattener.
And so I just think that like if they're gonna get rates down, there's like some point where that's gonna help accelerate the housing market again and get it back. But it just needs to be probably more than people think. Like it's got to be a couple hundred basis points basically to get it going. Like they get mortgage rates to
5. Something like over 75% of existing mortgages have a rate below 5%.
I think they got to get to 5 or 4 even. And so like that's why it's just like, hey, being long short end rates seems like the easier way to go for, hey, if the U.S. needs the housing market to get going again because it's kind of dilapidated, and you've been spot on the short side of this, the whole thing, is that like running this short can be tricky, right? Because the home builders in 08, they bottomed well before the bottom of the market. If you look back at the charts and stuff. So that's the one thing I would caution any listeners here is that this trade is a cyclical that will anticipate the rebound. So there's going to be a point where, and even in 22, actually, I remember I was in Aspen, Colorado, and a buddy of mine told me that buying DHI was like a no-brainer, like $55 there in June of 22, and that was a good buy. Like those guys are really good, and then it went on a run, and so the broad market didn't bottom till fall June of 22, but sometimes these things have a way of like being a little bit before the market. You know what I'm saying?
I mean, think about this. I mean, we started getting on this trade in August, September, so we were probably 2 months early. Most of the home builders peaked somewhere between September and November, and they're down 30 or 40%. In that time frame, at least through January, the market was going to a new high, the S&P. So it was a huge trade on the short side in an up market. So you're right, they did anticipate, in their action. And that's why I'm a little bit leery about pressing anything here, because I do think you're right that we get lower mortgage rates, and you're ending the spring selling season. What I don't think you're going to see is home price appreciation. In other words, sale prices will be below listing prices. So the negative wealth effect on the consumer is going to continue, I think, to impinge on consumer sentiment. And that's been my call all along. Is not that this housing crash, if it develops that way, is going to be very different than '07, '08, '09, in that it's not going to impair the banking system, but it is going to cause a negative wealth effect on the consumer. And I think, Ben, you've talked about this as well. But if Trump wants to get rates lower, he's got to take the high-end consumer out of the equation, because they're supporting this economy with their
Yeah.
spending. And
Yeah.
the two big things that the high-end consumer owns, that their most important asset, is housing and stocks. And so if you can create an environment where housing and stocks, devalue or deflate, then you're going to lose some of that confidence at the high end, and that will help get rates lower and slow activity.
Although I would argue it's a little bit more nuanced than that, in the sense of, like, take stocks down. Stocks are the look, we all can mark our homes at whatever we want, right? Like, oh, hey, the guy in the other neighborhood sold it at this. Like, the housing's the ultimate low float asset class that's based on like a few transactions, and everyone just assumes what prices are. But the reality is it's not a real market the way stocks are. Stocks are selling trillions, billions of dollars every day. There's buyers and sellers. And the stock market is high frequency data. Take the stock market down, that's what we'll get. And the best example that I can give is I don't know, I think I sent it to you boys, but like frozen concentrated orange juice futures, the Duke Bros of Trading Places fame, just got rug pulled. And I saw that orange juice got hit at the grocery store by 30%. So this can happen. You take the market down, you can beat inflation, you can make it and Trump's a populist president, and so I'm totally with you on that. I just think that the housing thing, if they get rates down, there will be that game will come back in essence. And maybe the better play is, furniture, or some guys who serve that market. I don't know. Because the home builders, let me ask you this, Charlie. The home builders could be hurt in that scenario, because all of a sudden there'll be a lot of supply, right? Like everyone who's now can get in the game of selling their home, whereas before they were stuck. So we had, over the last couple of years, we had this very tight supply, which supported prices, and the home builders were in essence the only game in town. Is that roughly right?
Yeah, in fact, I had an Excel spreadsheet that I've shown a couple of times, and if you look at the market share shifts, between existing homes and new homes, in the last year or so, new homes have taken share, but that's because there's been a dearth of supply of existing homes. Now we're starting to see existing homes coming on the market very aggressively. Robert's area in Broward County, Fort Lauderdale, the supply of new homes is just accelerated. So I think it's going to be tougher for the new home builders to compete, given what I think is going to be a flood of supply if rates come down. So I agree with you. Yeah.
Charlie, how big a drop do you think the market experiences over a multi-year period? 20, 30%?
Well, I've pointed out that existing homes affordability of existing homes are about 25% above trend. So that's the kind of deflation in home prices that I think could happen. And you're right, Robert, in saying things like homes take time to revalue. It doesn't happen overnight. Existing homes are only about 15% above the trend for affordability. So somewhere between 15 and 25% is the kind of price drop I would expect in homes prices. Ben, I just want to mention very quickly Citigroup, because it's been my number one pick. In the FT this morning, there's a story about essentially another fat-fingered trade that Citi screwed up on. Where they were supposed to transfer 280 million and they transferred 81 trillion to a client. I want to point out very quickly, this is more headline risk than fundamental risk. This is a trade that the FT discovered that took place in April of 24, and they're just dragging it up now. This is a trade that Citi brought to the attention of the regulators. They were fined 136 million in June of 24, and there were no other, issues that emerged after that in terms of the regulatory oversight. There was a consent order that came out last year that we're all aware of that said you've got to do a better job on your controls and risk management. So the story resurfacing now is old news. It does raise a black eye for Citigroup, that they're still
We're
having
talking about
problems.
the 81 trillion, right? The 81
81
trillion.
trillion, yeah. And so it is a
I wish
black
they
eye.
would send me and Robert 81 trillion. We would have a nice weekend in Vegas together.
Yeah, probably lose it all too. but yeah. But anyway, I just want to make sure everyone understands that this is old news. There's no regulatory ramifications from it, and those already came out last year with the new consent order that Citi's working under. And the big concern would be is if they were, one, forced to stop growing the balance sheet, and two, couldn't return capital, because return of capital is the big story at Citigroup. That I think they're going to have a $10 billion share buyback program next year once they get Banamex IPO underway, and that's 6% of their outstanding stock. So if it does come in here in a weak market, I still think it's a buy. So I just wanted to get the Citigroup thing. And then finally, next week we have a bank conference where we're going to get updates, on the mid-quarter. I think these updates will be much more quantitative than qualitative. So in February we had a banking conference. The updates were qualitative. The one area that I would look for, and Ben, you may have some thoughts about this. Investment banking we know is weak. It started off weak, and I don't think it's picked up. If anything, so the weakness really was around M&A. We had January was one of the lowest M&A completions in the last 10 years. But we've had a relatively healthy IPO market and a very strong debt underwriting market. The thing that I want to point out is the IPOs in the secondary market have performed very poorly. And so all I have is the IPOs from January. So if the buy side starts to feel less confident about buying these IPOs, that's the second leg of the investment banking trio that could fall and disappoint. So I would look for any commentary about whether IPOs have continued to be robust, because they were in January. They were very robust. But the secondary market may cause a change in attitude about IPOs. And the M&A market we know has not picked up yet. And then finally, I would look to any comments on trading, because now we'll have 2 full months of trading under the belt. Last conference, JP Morgan said their trading was going to be up double digits, and that was better than expected. Now, keep in mind, trading 1 month can turn around to be very good or very bad. So if we get an update, so most people now are expecting trading to be very, very robust in the first quarter. If we get an update that trading is not so good because of the volatility here, and basically banks do make more money in rising markets, and we've had a pretty good correction here in February. So I think, and here I'm guessing because I don't know what's going on internally. I'm guessing that trading is not going to be so healthy if this market sell-off continues. And that's where you could get a negative surprise on these investment banks and money centers. So,
Isn't trading usually there's more trading when things get a little crazy? Like, I mean, I've looked at volumes have been really low, and then when guys actually sell is when volumes rise, right?
yeah, I mean, banks typically make more money in a trending market that doesn't have huge volatility. So there's good volatility and there's bad volatility. Bad volatility is when you have gapping prices, you have intraday swings. You start down and you move up. That is bad volatility, and I think that's what's characterized last couple of weeks, Ben. And then banks do carry some inventory, not a lot of inventory, and so if prices deflate, that's not good either. This is
Yeah.
a guessing game. this is a guessing game because everyone manages their book differently. But that's, all I'm saying, Ben, is that if there is a negative surprise next week at this banking conference in terms of guidance, it's likely to come on the trading, because people got very bullish when JP Morgan said trading is up double digits.
What they should be bullish about is the fact that I think the banks have some hidden risk. I told you yesterday that I heard that they're housing a lot of this dispersion trade risk that the hedge funds have offloaded to the banks,
Right.
which that's just Wall Street. I talked to a Wall Street guy, and I'm just passing it along. It's just a whisper, if you will. But the private credit we've talked about, Charlie, right? And they do have more exposure than people realize. And there's definitely something going on, because the private credit guys are now going to list ETFs unloading their shitty product onto the public, because that's what they do. Just like in 07 and 08, where they got rid of their swaps and their CDOs, and then they remarked their books, right? Like, it's just replaying it. And so I wonder if the banks are the guys behind them saying, "Hey, you gotta shore this up," basically.
There was a very good article on Bloomberg yesterday or the day before about the games that accountants, investment banks, and commercial banks are playing to offload portfolio companies that private equity holds that are in trouble. And this was exposed in a lawsuit, so documents. I really do believe that private equity and private credit is the epicenter of the next problem, because they have been marking their books to myth or not to market.
Fantasy. I like to call it fantasy. By the way,
Yeah.
I was chatting with my buddy in Singapore last night, and he noted that the Bank of Japan is going to no longer let them do these the notes that are secured by JGBs but that aren't marked. So I just think this whole industry, VC, private equity, private credit, this garbage where they don't mark their bonds, this whole world of not marking is about to have a reckoning. I think that's what when we look back at this whole 2025 event, it's going to be like all the fake players who thought they were finance guys who just don't mark. They're the ones who are going to take the pain here.
Yeah, and Ben, your observation about this ETF, that they want to sell to retail, that just tells you we're getting close to the top of the market.
Totally.
You're taking a product that's supposed to have no liquidity, and you're pretending to give it to retail as a liquid product. It just doesn't make, there's no common sense in that transformation. But the other thing that these private equity guys have done, a lot of them have bought insurance companies. And insurance companies are under a different accounting system because they play in long duration. And so I think, we'll find out, all these things come out after the problems, develop in the markets. But I think you're going to find out that a lot of stuffing of, private debt and long duration assets have been put into these insurance companies, and therefore have not been marked to market. So there's a lot. It really reminds me of what the banks were doing with MBSs during the 06, 07, before the sun shone on what games were being played.
Let's just Robert, maybe you can chime in here too. I mean, the BDCs, isn't that what the hell a BDC is? I mean, more or less, it's like, oh hey, we're gonna private credit ETF. Isn't that what a BDC is? Like when I look at like Blue Owl, who, by the way, 25% of their income is PIK income, which, by the way, PIK, payment in kind, for the listeners that don't know, that's not payment in cash.
No,
it's payment in Robert, what do you think about the PIK
Ben,
income?
Charlie, you know this. I'm in Financial Stocks Anonymous. I have an 800 number to call when I think about buying a financial stock. They talk me out of it.
Yeah. It's funny you mentioned Blue Owl, because but they're very tight with a major commercial bank that everyone reveres. And as a private banking client of that commercial bank, they've been trying to stuff me with some of the Blue Owl product, and I said thanks, but no thanks.
We appreciate it. We appreciate you thinking of me, but
thanks for thinking of me. Lastly, Ben, I just want to point out, back on December 19th, the day after the FOMC meeting, I came out and said, you got to fade Bitcoin over 100,000 and buy gold. Um, and I said that because Powell in his press conference was asked, is Bitcoin going to prove to be a competitor to the US dollar? And he said, no, it's not a competitor to the dollar. It's a competitor to gold. It's digital gold. And this was the second time that he's made that statement. The first time was back in March of 21, where he called, Bitcoin digital gold. And I went back and looked at that analog of March of 21 when he made that statement at the BIS conference in Europe. And I pointed out at last December that when Powell made that comment in March of 21, Bitcoin rallied for about a week, peaked, and then dropped 50% into July of 21. And I said, I really feel that that's going to be the same sort of analog today, that Bitcoin will peak at over 100,000, and it's going to drop by 50%, so under 60,000 by, the spring, summer of this year. And I think we're on track for that. So I mentioned that because Bitcoin has dropped now in the last week or two very violently. Some of the technicians will tell you there's support around 78,000. And Bitcoin could very easily.
There was last night. There was. I was watching it. That's exactly. It got to about 78K, and there was a bid. It was a fight there. There was a dog fight last night at 78, 79K, and said, hey, 83 now. So there was definitely a bid there.
Okay. So yeah, so some kind of bounce here, but I think we're still going to 60,000 or lower, by the spring. So I'm not a fan.
What stock do we want to short? If we want to don't short Bitcoin directly, what stock do we want to short?
I mean, MicroStrategy convertibles all day. MicroStrategy convertibles are one of the most asymmetric, easy trades right here because this guy struck at 69. Just so everyone knows, because I realize I'm getting excited. I understand this quite well, and this is a Ponzi scheme, and I know people don't like using that word, but it is Ponzi-like, let's say, Ponzi-like. And he had to pull his last convertible. He didn't get that done. So the market might have no more interest in his paper that has 0% coupons. That's like, oh, hey, the bond market wants Bitcoin. His whole game was giving the bond managers, like you guys know bond managers, some convexity in their portfolio, which could add an extra 10, 20, 30 basis points, which then they outperform their benchmark, and then they're the hero at T Rowe or Capital or my old firm Fidelity, whatever. It doesn't matter. Like basically that was the game he played, and seems like, oh well, there's not that many interest now here at 0% coupon, and he doesn't have enough cash flow in that underlying software business. He's getting the interest coverage is going like this. And so, but everyone knows Ponzi-like operations need more money to keep coming in, right? And he needs high Bitcoin because then he can buy it, and then there's a premium, and then he can basically issue equity at a premium to the underlying Bitcoin, so that the price to book justifies issuing equity. Well, what people are going to find out, and what's happening all over the place, the other side of the mountain, when the order of operations go in reverse, where the Mag 7's not going up, so now your stock comp isn't a hidden way of paying your employees, and capital gains are 4 to 5% of GDP, and there's all kinds of things like this, deleverage of businesses. This thing, short the convertibles of MicroStrategy all day. Like the stock is going to be volatile, so I don't know if you want that noise, Robert. But that thing could go bankrupt if Bitcoin falls apart.
You just took the words right out of my mouth. I was going to mention Mr. as well, and I do believe that that's the kind of name that could go bankrupt if we get Bitcoin dropping by 50%. So we'll see. But
they've averaged up. Sailor's averaged up, right, to where his price
69K. 69K. Yeah, he struck at 69K, which, by the way, last night he was 9K in the money. That's a butt clench moment right there. Like I bet he was in there like,
when he goes into the red on his Bitcoin trade, it's going to get very ugly very quickly.
Yeah, so if I'm right, we're going to
bondholders are going to come for the Bitcoin. These bond guys, bond guys don't care. They're like, hey, we have a claim on those assets. we're going to sell those assets, right?
Right.
That's how bond
Yeah.
guys operate.
It's a liquidation trade. Yeah. But the other side of that trade has been, being long, GLD, and in a relative basis, that has paid off because GLD went to new highs. Now it's in correction mode right now, and we could see 20.
Finally,
Yeah,
right? Like it's been. I
yeah,
mean, I've been waiting for a gold correction forever, and I love gold, but I mean, come on, it can't just go up every day forever.
yeah. And no, so we could see 2,800. That wouldn't shock me, but I think it's a buy down there. I still think we're going to see 3,000, 3,050 on the next run, and I think that's going to happen by springtime. I'm a buyer on this weakness of gold, but it's certainly outperforming Bitcoin. That's the point I was making.
Mm-hmm.
Yeah, I mean, I think in the short term, like there's a lot of movements going on that are some positioning oriented stuff like that. I'm long the dollar right now, for example. I think there's not a lot of people long the dollar. I just bought a lot of dollar upside this week, and there's just not a lot of people talking about that. And I did buy a little bit of gold on the sell off, but I kind of am anticipating it to keep going down because I just it's over its skis.
The gold dollar, correlation has broken down though, Ben. It used to be dollar up, gold down, but that hasn't been the case in the last 2 years. There's a different regime. No. There's a different regime underlying gold right now. Is what I'm saying.
Well, I would just tell you that the dollars in the last 2 days is went up a big figure basically, and so that's starting to work. And so gold going down did get hit by the dollar move here. And my plan of action is to take this dollar, which is trade, and I think we get a blow off top in the dollar, and then I'll put all that profit into the gold basically, because there will be a point where Trump and these guys rug pull the dollar. Like the other side of this with lower rates and all this, the dollar will go down. You got to get there first. Is my kind of view. And then all the Robert Small Caps, the equal weight, that stuff's going to massively outperform.
Yeah. My point was that I think there's been a breakdown between the correlation of dollar and gold. And if you wait till the dollar peaks and rolls over before you buy gold, I think you're going to be late. I think gold is actually going to move up at some point in conjunction with the dollar because if you look at the last 2 years, the correlation is broken down. So we'll see.
Yeah, we'll see. Absolutely. We'll definitely see.
That's a good place to terminate this hour, gentlemen, in my opinion.
Oh, that's a guy who wants to go hang in the sun. Look at that guy. Guy's like, hey, I gotta go play some golf.
I gotta put the bathing suit on there. I'm missing the early sun, gentlemen. Come on.
All right. Well, look, it was a great week. This is actually a really nice show in a good way. I love these guys. Wall Street Beats, come check us out. We're always chatting, putting up research and giving you ideas. Come check us out and have a great weekend. It's been quite a week, and I bet you it's going to be a crazy March. So come hang with us. Later.
Yeah. All right. Take care. Thanks, man.